Today is our training session about tax filings and compliances in Capital Flow. After completion of this session, we hope that you will get an idea about tax filings and compliances. What we do, our experts will help you in providing services to the people. Start and grow your business easily without any non-compliances, from filing TDS returns to professional tax registration. In tax filings and compliances, we provide three services: TDS returns, ESI returns, professional tax registration. TDS returns. Before knowing about TDS returns, first we should know about what is TDS. TDS, tax deducted at source. As per the Income Tax Act, any company or person making a payment is required to deduct tax at source if the payment exceeds certain threshold limits. TDS has to be deducted at the rates prescribed by the tax department. The company or person that makes the payment after deducting TDS is called a deductor, and the company or person receiving the payment is called the deductee. It is the deductor's responsibility to deduct TDS before making the payment and deposit the same with the government. TDS is a source of collecting tax by Government of India at the time when a transaction takes place. TDS is deducted irrespective of the mode of payment, cash, check or credit, and is linked to the PAN of the deductor and deducted. Tax is deducted on the following types of payments: salaries, interest payment by banks, commission payments, rent payments, consultation fees, professional fees. However, individuals are not required to deduct tax when they make rent payments or pay fees to professionals like lawyers and doctors. Tax deducted at source. As per Income Tax Act, 1961, TDS is classified under different sections. Each section describes about different types of payments. Now we will go through different sections of TDS as per Income Tax Act, 1961. Section 192, Payment of Salaries. Section 193, on payment of interest on securities. Section 194, dividend payment. Section 194A, interest payment by banks, post offices, cooperative societies, others. Section 194B, winnings from lotteries, games, puzzles. Section 194BB, winnings from horse races. Section 194C, payment to contractors or subcontractors. Section 194D, payment of insurance commission. Section 194DA, maturity proceeds of a life insurance policy. Section 194E, payment to non-resident sportsmen, sports association. Section 194EE, deposits in National Savings Scheme. Section 194F, repurchase of units by mutual funds and Unit Trust of India. Section 194G, commission on sale of lottery tickets. Section 194H, commission or brokerage. Section 194I, rent on plant and machinery, building, furniture. Section 194IA, consideration for transfer of immovable property other than agriculture land. Section 194IB, rent on immovable property. Section 194IC, consideration, not being in kind, under the Joint Development Agreement or other similar agreement. Section 194J, payment for professional services, technical services, royalty. Section 194LA, Compensation on the acquisition of certain immovable property. Section 194 LBA. Income distribution by a business trust under Section 115 UA. Section 194 LBB. Income distribution by an investment fund under Section 115 UB. Section 194 LBC. Income distribution by a securitization trust under Section 115 TCA. Section 195. Payment to non-residents. Now we will go through detailed explanation of each section. Section 192. At the time of payment of salaries to employees, tax to be deducted as per slab rates in Income Tax Act, 1961. Section 193. Interest on securities, tax to be deducted by any person, if interest amount exceeds Rs 10,000, tax rate at 10%. Section 194. At the time of dividend payment, tax to be deducted by company, tax rate at 15%. Section 194A. Interest payment other than securities, tax to be deducted by any person other than individual or HUF not liable to tax audit in last previous year. If the interest amount exceeds Rs 10,000, the limit is Rs 50,000. In case of deductor, being a resident senior citizen. Section 194B. Winning from lotteries, crossword, puzzles, card games etc. Tax to be deducted by any person, if the winning amount exceeds Rs 10,000. Tax rate at 30%. Section 194BB. Winning from horse races, tax to be deducted by any person, if the winning amount exceeds Rs 10,000. Tax rate at 30%. Section 194C. Payment to contractors or subcontractors, tax to be deducted by any person other than individual or HUF not liable to tax audit in last previous year. If the payment amount for single payment exceeds Rs 30,000 or aggregate payment exceeds Rs 1 lakh in a year, tax rate at 1% if contractor is individual or HUF, 2% in case of others. Section 194D. Payment of insurance commission, tax to be deducted by insurance company, if the commission amount exceeds Rs 15,000 per annum, tax rate at 5%. Section 194DA. Maturity proceeds of a life insurance policy, tax to be deducted by any person, if the proceeds amount exceeds Rs 1 lakh, tax rate at 1%. Section 194E. Payment to non-resident sportsman or association or entertainer, tax to be deducted by any person, no threshold limit, tax rate at 20%. Section 194EE. Deposits under National Savings Scheme, tax to be deducted by any person, if the deposits amount exceeds Rs 2,500, tax rate at 20%. Section 194F. Repurchase of units by Mutual Fund and United Trust of India, tax to be deducted by any person, no threshold limit, tax rate at 20%. Section 194G. Commission on sale of lottery tickets, tax to be deducted by any person, if the commission amount exceeds by Rs 15,000 per annum, tax rate at 5%. Section 194H. Any other commission or brokerage, tax to be deducted by any person other than individual or HUF, not liable to tax audit in last previous year, if the commission or brokerage amount exceeds by Rs 15,000, tax rate at 5%. Section 194I. Rent on plant and machinery, land, and building, furniture, tax to be deducted by any person other than individual or HUF, not liable to tax audit in last previous year, if the rent amount exceeds rupees 1,80,000 per annum. Tax rate at 2%, in case of plant and machinery, 10%, in case of land and building, furniture. Section 194IA. Consideration for transfer of immovable property other than agriculture land. Tax to be deducted by any person, if consideration exceeds rupees 50 lakhs. Tax rate at 1%. Section 194IB. Rent of immovable property. Tax to be deducted by individual and HUF, other than covered under Section 194I, if rent amount exceeds rupees 50,000 per month. Tax rate at 5%. Section 194IC. Payment under joint development agreement. Tax to be deducted by any person. No threshold limit. Tax rate at 10%. Section 194J. Payment for professional services, technical services, royalty. Tax to be deducted by any person other than individual or HUF, not liable to tax audit in last previous year, if the payment exceeds rupees 30,000 per annum. Tax rate at 10%. Section 194LA. Compensation for compulsory acquisition of immovable property. Tax to be deducted by any person, if compensation exceeds rupees 2,50,000 per annum. Tax rate at 10%. In case of compulsory acquisition of rural agriculture land, no need to deduct tax. Section 194LB. Interest on infrastructure debt fund. Tax to be deducted by infrastructure debt fund. No threshold limit. Tax rate at 5%. Section 194LBB. Income distribution by an investment fund under Section 115UB. Tax to be deducted by investment fund. No threshold limit. Tax rate at 10%. Section 194LBC. Income distribution by a securitization trust under Section 115TCA. Tax to be deducted by securitization trust. No threshold limit. Tax rate at 25%. In case deductor is individual or HUF, 30%. In other cases. Section 195. Payment to non-residents. Tax to be deducted by any person. No threshold limit. Tax rate at 20%. End of sections. Important points. Requirement to deduct tax at source arises 1. At the time of payment, or 2. At the time of credit of account of the person, whichever is earlier. But tax should be deducted only at the time of payments in the following cases: salary, EPF payment, winnings, maturity of life insurance policies, compensation on compulsory acquisition of immovable property, as per Section 2 subsection 31 of Income Tax Act 1961. Person means 1. An individual, 2. A Hindu undivided family, HUF, 3. A company, 4. A firm, 5. An association of persons, OP, or a body of individuals, BOI, whether incorporated or not, 6. A local authority, and 7. Every artificial juridical person like trusts, educational institutions. Due dates for payment of tax deducted at source to government. If tax is deducted by government office, amount paid or credited, without challan, the due date to deposit tax is on same day. Amount paid or credited, with challan, the due date to deposit tax is on or before 7th of next month. Amount paid or credited, on perquisites, benefits, opt to be deposited by employer, the due date to deposit tax is on or before 7th of next month. If tax is deducted by others, amount paid or credited, in the month of March, the due date to deposit tax is on or before 31st April. Amount paid or credited, in other months, the due date to deposit tax is on or before 7th of next month. For example, tax is deducted in the month of April, the due date to deposit tax is on or before 7th of May. TDS returns. A TDS return is a quarterly statement which has to be submitted to the Income Tax Department. Submitting TDS returns is mandatory if you are a deductor. TDS return consists of details of tax deducted and deposited by you. Eligibility criteria. TDS returns can be filed by employers or organizations who avail a valid tax deduction and collection account number. TAN. Any person making specified payments mentioned under the Income Tax Act are required to deduct tax at source and needs to deposit within the stipulated time. Through TDS, some portion of your tax is automatically paid to the Income Tax Department. Thus, TDS is considered as a method of reducing tax evasion. Documents required to file TDS returns. Copy of TDS challenge deposited. PAN of deductees. Amount of TDS deducted and date of deduction. Exemption certificates. If TDS is not deducted on any payments. Nature of expense for which TDS is deducted. Bank statements and invoices as supporting to check payments. Optional. Advantages for filing TDS returns and disadvantages for non-filing TDS returns. Advantages: ensures a flow of regular income to the government, reduces the burden of lump sum tax payment. It helps in spreading the entire tax payment over a number of months, which makes it easier for the taxpayer. It helps in regular collection of taxes. If you file TDS return on time, hence no need to pay interest, penalty and disallowance of income. Disadvantages: fees for late filing of TDS under Section 234E, penalty for late filing or non-filing TDS under Section 271H. Interest shall be levied on late deduction and late payment of TDS. TDS returns forms. Form 24Q. Statement for tax deducted at source from salaries. Form 26Q. Statement for tax deducted at source on all payments other than salaries. Form 27Q. Statement for tax deduction on income received from interest, dividends, or any other sum payable to non-residents. Form 27EQ. Statement of collection of tax at source. Due dates for TDS returns filing. TDS returns to be filed quarterly. For first quarter, April to June, due date to file TDS returns is on or before 31st August. For second quarter, July to September, due date to file TDS returns is on or before 31st October. For third quarter, October to December, due date to file TDS returns is on or before 31st January. For fourth quarter, January to March, due date to file TDS returns is on or before 31st May. Consequences or penalty for late filing or non-filing of TDS returns. Penalty for delay in filing TDS returns. According to Section 234E of Income Tax Act, 1961, if an assessee fails to file his or her TDS return before the due date, a penalty of ₹200 per day shall be paid by the assessee until the time the default continues. However, the total penalty should not exceed the TDS amount. Penalty for non-filing of TDS returns. If an assessee has not filed the return within 1 year from the due date of filing return, or if a person has furnished incorrect information, he or she shall also be liable for penalty. The penalty levied should not be less than ₹10,000 and not more than ₹1 lakh. ESI, Employees State Insurance returns. Employees State Insurance is one of the popular social security schemes brought into force by the central government after the independence of India. All employers having 10 or more employees are required to be registered with Employee State Insurance (ESI) Corporation. Those entities having ESI registration must file ESI returns. Some percentage of contribution is deducted from the employee's salary by the employer. The ESI scheme provides tremendous benefits to the employees and has a large network of dispensaries and hospitals throughout the country for facilitating fast and efficient medical care. Documents required to file ESI returns: attendance register, register for Form 6, register of wages, register of any accidents on the premises, inspection book, monthly challenge. ESI payments and returns due dates. ESI contribution payment to the government within 15 days from the end of month. For example, for the month of April, the due date to pay the contribution to government is on or before 15th of May. ESI returns due date. ESI return to be filed half-yearly, twice in a year, within 42 days from the end of half-year. For the first half-year, 1st April to 30th September. The due date to file return is on or before 12th November. For the second half year, 1st October to 31st March, the due date to file return is on or before 12th May. Professional tax registration. Professional tax is a tax levied on professions and trades in India. It is a state-level tax and has to be compulsorily paid by every member of staff employed in private companies. The owner of a business is responsible to deduct professional tax from the salaries of his employees and pay the amount so collected to the appropriate government department. Professions means chartered accountant, company secretary, lawyers, doctors, and so on. Important points. The persons falling under the ambit of professional tax and the employers employing staff for their business need to acquire registration with proper department designated for compliance of professional tax in a specific state within 30 days of coming under the domain of the applicability of professional tax. Every expert, the directors of company, designated partners of the LLP or some other employer is under obligation to seek registration as specified above and to ensure that expert professional tax is deducted from the pay of employees. Reasons to obtain professional tax registration. Statutory requirement. Employers in certain states are required to mandatorily obtain professional tax registration, deduct and pay service tax on behalf of employees. Avoid penalty. Failure to obtain professional tax registration or remit professional tax could result in fines and penalties that accrue over time. Tax deductible. A deduction from salary can be claimed by the taxpayer on account of professional tax paid. The deduction for professional tax will be allowed in the year in which the tax is actually paid by the employee. Easy compliance. Compliance with professional tax regulation is easy. Professional tax registration can be obtained easily and compliance maintained easily. Documents required for professional tax registration. Address proof of establishment. Any utility bill and NOC if establishment is rented. Address proof of partners, proprietor or directors as applicable. Driving license, passport, PAN card of partners, proprietors and directors as applicable. Photo of partners, proprietors and directors as applicable. Salary details of employees, certificate of incorporation and address proof in case of company. Financial statements of establishment, if it is not first year of establishment. Some other points. The tax is based on slabs depending upon income of individual who may be self-employed or working as employee of an entity. At present, the maximum tax that can be imposed is restricted to Rs 2,500. Professional tax is imposed only in certain states: Karnataka, Bihar, West Bengal, Andhra Pradesh, Telangana, Maharashtra, Tamil Nadu, Gujarat, Assam, Kerala, Meghalaya, Odisha, Tripura, Madhya Pradesh, and Sikkim, who is responsible for deducting the tax and depositing the same with government. In case of individuals who are self-employed, the tax has to be paid by the individual himself. In case of employed individuals, the liability is on the employer. Process time to get registration: within 5 to 7 working days. Thank you for watching.